Hi, and good afternoon. Welcome to our quarterly market update from Morton Brown Family Wealth. I'm Dennis Morton here with my partner, Katie Brown, and financial advisor, Cody Demmel. How are you guys doing today?
Great.
Good. Good. So as we get ready to wrap up 2020, we wanted to share some insights about what we've seen this year, some of the changing landscape that's happened around the election, and also how we're thinking about preparing for 2021 from a planning and investing perspective. And you've chosen to spend time with us today. We're very appreciative of that. It's been said that spending time with a financial advisor is a combination between marriage counseling, a visit to the dentist, and high school calculus. So you might be saying to yourself, you know what, if all those things are in person, that doesn't sound too bad right now. But here we are in a virtual environment, and we're just going to share some thoughts that we have just to help you be a better decision maker, be a better leader in your own personal finances. And we want this to be very interactive. So if you do have a question during the course of the conversation today, if you have anything that you were getting into jargon or some things that you would like explained, feel free to comment in the chat section, and we'll be able to answer it in the course of the presentation, or we'll leave time for Q&A here at the end. This is a crowded virtual room today. We have a lot of participants, some familiar names, and some new friends who have joined us for the first time. So maybe it'd be helpful to start with a little bit of an introduction. Katie, you want to walk through some of the work that we do?
Sure, of course. So Morton Brown Family Wealth is a fiduciary advisory firm founded here in Allentown in 2018 with a vision of building a community of clients and professionals leading purposeful lives through the stewardship of wealth. Our community has grown since our founding, and we now serve over 130 families in 15 states and oversee $160 million in assets. Dennis and I are both certified financial planners and chartered financial consultants, which signifies our expertise in holistic planning, including things like investments, retirement, taxation, estate law, and insurance. Our focus is on the unique decisions that families make about money and their legacy. But a quick disclosure, really quickly, we are not CPAs or attorneys. So when we get into the tax and legal weeds, we make sure to bring the entire advisory team to the table.
Thanks, Katie. So in working with families, we found that there are 3 traits in common with a lot of our relationships, and we're going to try and bring some of those values forward today in the course of the conversation. The first is humility, which is accepting that we can't know everything and we need to prepare for the unexpected, which I don't think there's any better concept than that in 2020. The second is curiosity, and it's the willingness to learn more about ourselves and ask better questions about the world around us. And finally, community, which is what we're doing today. We want you to benefit from the conversations that we've had with many families over the years and the ones that we're having today to share what we've learned, but also the chance for you to learn from each other. I'm sure if one person's thinking about one topic and has a question, there are a dozen others wondering the same thing. So we would encourage you to ask questions, make this interactive, and benefit from that sense of community. Katie, you want to walk through the agenda for today?
Yeah, so as Dennis mentioned, we've built an agenda today based on our observations of this extraordinary year, the conversations that we've had with clients, and the investing topics that we're curious about heading into 2021. So we're going to start with a year in review. Cody and Dennis are going to walk through the ups and downs of the year thus far. Then we'll head over to a post-election financial planning discussion where I'll be highlighting some potential tax law changes and what they may mean for you. And then Dennis is going to walk us through investing fast and slow, where we look forward with pace in mind, recognizing areas to accelerate and to slow down. And then, as Dennis mentioned, we'll leave some time for Q&A at the end. But once again, please feel free to post questions throughout the presentation in the chat box. And we're happy to go deeper into any particular areas or clarify anything that you might be wondering.
All right, thanks, Katie. So we're going to start with the year in review. And I put a little quote up here from one of my favorite investing books, A Random Walk Down Wall Street. Part of the genius of financial markets is that when there's a real demand for a method to enhance speculative opportunities, the market will surely provide it. And if there's one thing that's been for sure about this year, it's the opportunism, that there's been opportunities to get out, get in, and maneuver all through different phases of the market. It's really been a market cycle encapsulated in one year. We're going to start this by a quick pop quiz, and I say quick because I don't want anyone, racing to their phones to cheat too much. But we're going to run a quick survey here, and I'd like you to answer within plus or minus 2%. this question. What is the total return of the S&P 500 this year? -5%, 0%, +5%, or +10%? Give you a couple seconds here. Lots of responses. Very good. All right. Give you another second or so. And the reason we've asked this question first is because in conversations, just walking around and with clients, a lot of times we've been anchored at different periods of the year, that we had such a dramatic decline in March that for many quarters after, there was still the perception that the market was down substantially more than it was. And also that this volatility had increased. At certain times of the year, there was very little volatility. So we're going to end the voting here and show you the results. All right. So as you can see, we have 36% saying +5%, and we have 47% saying +10%. As of yesterday's close, the S&P 500 was up over 15% year to date, having been down 34% at one point earlier this year. So glad to see that there's some awareness there that at least things are positive and looking good year over year. And we're going to talk about why this was such an unusual year, but also a very normal year. All right, Cody, you want to kick us off with our first chart of the day, courtesy of Jpmorgan.
Yeah, so as you said, obviously, year to date, we've been pretty positive throughout the stock market. We have had a lot of volatility, and there's obviously some sectors that are still pretty struggling. They're weighing behind. So those are the sectors where you actually had to do things in person, whether it's flying on the airlines, hotels, resorts, cruise lines. Those are still down pretty significant year to date. But then obviously technology and companies that were able to transition to adopt to everything that's happened this year have been doing really well.
Yeah, I think the interesting part about this was the strong got stronger. I mean, at the energy sector over here, all the way at the bottom, I mean, that had been down for years. It had been lagging behind. It continued to lag even more so. The tech sector, we're going to talk a little bit about, of the 500 stocks in the S&P 500, there's the 5 and the 495. So the 5 stocks on this end of the spectrum had really been carrying most of the water for the index before this pandemic started and even during the recovery. The interesting part is going to be what happens when you do get some of the service sectors like hotels and airlines and other elements like that. When they start to bounce back, what does it do? And we'll talk about those inflection points that have happened. One other thing to note about this side where we have online retail and information technology. It's not as if Zoom didn't exist before this year. It's not as if DoorDash, which just went public, didn't exist before this year. The companies that specialize in those areas, I think what's really changed is the pace of adoption, how quickly people are willing to say, I mean, think of all of us, I don't know how many Zoom calls you've been on before this year, but it's probably a lot more than, exponential growth in that. It's the pace of adoption that's really driven that, not so much that there was any kind of new technology. I think the newness is going to be an offshoot of what's happening here, but we really just saw an acceleration of a previous trend.
Yep.
Okay, so we have next.
Then the next chart. So this is a periodic table of the investment returns every single month so far in 2020. So this goes over the US stock market, both large and small, international stocks, and then also some fixed income, so bond-oriented positions. So actually, in the beginning of the year, it was interesting to see that fixed income outperformed, had positive returns, but then you can see, obviously, after that, after we had the large drawback in March, we've had equities outperforming. And it is important to point out that we possibly could be seeing a trend that's been underperformance over the past couple of years, potentially coming out up top with small cap outperforming large growth.
Yeah, if you wanted to be the smartest person in the room for the last decade, and this is last year's returns, you were in large cap US stocks, and that's been the winning trade for 10 years. Year to date, it is still the winning trade. But as Cody said, there's some there's some cracks in the facade there that are starting to change. And we want to talk a little bit about some core principles, one being diversification and why concentration is the enemy of that. And so really, this is a quilt chart, which many of you have seen before. It allows us to show the lack of a pattern, that there is no pattern from month to month, year to year on which investments rank at the top, which investments rank at the bottom. But it's that blend of those that zig and zag at different times and for different reasons that makes a lot of sense. So we use this as just kind of a check-in to say, where is the leadership and how is leadership shifting over time?
Yep, exactly. So then the next chart dives in a little deeper to the trends that we've been seeing recently. And this goes over the trend that we saw in November. So we'll try to make this chart seem a little more simple than how it looks. So the stocks on the left side of this underperformed year to date compared to the market as a whole. And then the stocks on the top chart in the top left had outperformance in November. So you can see energy, which obviously was hit really hard earlier this year, value stocks, so companies that are potentially discounted compared to the high growth stocks, had a outperformance in November. With hopefully the vaccine news and getting back to normal, we've seen a rotation into some of these plays.
Yeah, if you're a dividend investor or someone who's invested with a traditional value type strategy, you're going to find something like the dividend aristocrats strategy right here. This is something that's been lagging behind all of those high growth stocks for a while, suddenly started to pop up into outperformance. And it's those kinds of changes happen over time that we really need to be conscious of, because no one, and coming back to election-based investing, no one rings a bell and says the market's going to change on this day. It's really a lot of catalysts happening at weird times for different reasons that can cause these shifts to happen. And it's a reason why we want to make sure we're not, just focusing on what's worked well here for the last 5 or 10 years.
Yeah.
One other piece in there is you'll notice that healthcare, for all the talk about how the healthcare sector is doing incredible work to, solve for this pandemic, and all the Pfizers and Modernas of the world, healthcare sits in that lowly category of underperforming under both time periods. So sometimes the narrative doesn't always sustain, what works as from an investment strategy.
Yep. So then the next image that we have, so this goes over some of the, I guess it's just an easy way to see what a K-shaped recovery is that a lot of people are talking about. So obviously we had the shutdown, everything was hit pretty hard in March and April. We had the reopen, which was great. The stocks, everything bounced from the lows. But then since then, like Dennis talked about, the high growth stocks, the big five, so Apple, Amazon, those have all been performing well. And then till the past couple months, these other 495 have been doing okay from the bottoms, but they haven't rallied as large as these top five did. But over the past couple months, with the vaccine news and the hopeful reopening to back to normal, these have been picking up some steam in the stock market.
And I think this is the tension that you're going to continue to see. So we're looking ahead to 2021. We'll get to this at the tail end of the presentation, that this is going to be one year where we're living fully in pandemic mode, and another period of the year where we're living in something else, which is some variation of recovery. And that tension is playing out in the markets right now, depending which day you look. You may see, if you see the NASDAQ in negative territory while it Dow's up 1.5%, that's what's playing out, is this bounce back to say, we need to find out what some of these companies, service-oriented companies, what the brick and mortar are doing, after all of this opens back up. And it doesn't mean that the stocks in the pandemic play are now bad. It just means people aren't willing to pay as much for those, and that has an impact on prices overall. So how much is $1 of earnings from Amazon worth, or Peloton, or Zoom, any of these names? If we're not willing to pay as much for $1 of earnings, then that comes back. Valuations matter.
Yep. And then speaking of the K-shaped recovery and the abnormal year that we've had, so back in the financial crisis, we hit unemployment of around 10%. We didn't get back down to 6% unemployment till 2014. This year, we went all the way up to 15% unemployment. and then we're already back down to 6. It's just an abnormal year. Obviously, everyone knows that. But so far, the recovery's been abnormal in a pretty good way. And hopefully with the vaccine news and the reopening, that will continue.
Yeah, I mean, you notice how in previous, and these gray areas are previous recessions. So this is the recession of the dot-com bubble. This is the great financial crisis. You see that unemployment spikes up right up until the end of the recession, and then it just kind of begins this gradual decline. Same thing, peaks right around the end of the recession, gradual decline. And at some point, we're going to be looking at this and saying, does a gradual decline begin? Do we continue doing this, or do we can start to do that a little bit? And that's going to have a meaningful impact on what policy decisions you make. If you're sitting at the Federal Reserve right now, or you're a congressperson trying to decide on stimulus, it's really hard to hit this moving target to say, well, what industries need to be saved? Where does stimulus need to be targeted in order to be most effective? It's moving so fast, and that comes back to that fast and slow starting, stopping that makes it really hard as a decision maker.
Yeah, Dennis, you see the question that popped up?
Sure. Sure. Okay, good question, and thank you for pausing this. Large cap equity. So these are when you think of household name stocks. So this is the Apples, the Disneys, the Microsofts, the Home Depots. The S&P 500 is made up of the 500 largest stocks in the United States based on the size of their market capitalization. So those are the big names that you have. So an example of a small cap stock, by contrast, would be something like DocuSign. It's not worth hundreds of billions of dollars. It's worth a couple $1 billion, and it's going to not necessarily drive its industry. A large cap stock is going to have significant weight. So when Disney decides to launch a streaming service, it changes their industry. There's ripple effects all throughout. So that's where you're going to see the big players stay. Small cap stocks are different. They're a little bit riskier. They tend to earn more over time, but there's a greater risk of them failing. There's a greater, they take on greater debt. They're trying to grow their way up. So there's just a different profile between large and small. So I hope that helps. And right now, just looking back, Cody, if we could flash back to I'll pull back here. So this has been the story that's worked for the last 10 years. If you wanted to be right, most of the last decade, you bought large US stocks. That's what's worked. So everything else has been somewhere behind that, but that's not always been the case, and we'll get to that. So great question.
Yep.
Okay.
And then one other interesting chart. So a lot of talk, obviously, around the election, and people were worried about potentially selling off they weren't sure who was going to win, what was going to happen. And just one thing that we wanted to point out is it wasn't really about the election. It was more about the stock market. It was more about the vaccine news, the reopening. And if you sold before the election, you missed around a 10% rally. And that was mostly because of the vaccine news that we've had and all the positive, hopefully vaccine news and reopening.
Right. And I think one of the things about when we hear people talk about getting out of the market and trying to, then they say, I'll get back in when things feel more certain. And, we heard before the election, or is this going to be thrown into the courts? Is there going to be question as to who comes out on top? And we did have some of that uncertainty for a couple of weeks, but it was the uncertainty that market climbed that wall of worry, really peaking out in the middle of November and kind of staying the ground the rest of the way. By the time things are certain, you've probably missed it. In this case, 9 or 10% is a year's worth of returns in the stock market. So that uncertainty is costly if you miss just a handful of days. So I think it's an important thing to realize that, as you said, Cody, the election wasn't necessarily driving it. No matter who took office, and no matter what situation we're in after the Georgia runoff, it's still going to be pandemic response that's going to drive the markets here in the near term. So I'll pause there. If there are any questions, feel free to shoot them up. Otherwise, I'm going to hand this over to Katie to talk about post-election financial planning.
Yes, thank you, Dennis and Cody, for giving us that recap of this incredible and historic market year. And, as if our heads weren't spinning enough from that roller coaster ride, we're all trying to make sense of how this political shift will impact our personal lives. So to kick off this discussion, I'd like to actually take another poll. I'd love to gauge how concerned each of you are that the proposed tax law changes will impact you directly. I'm going to dive into the details a bit, but let's start with how you're feeling right now. So we're going to cue that up for you. And, I'd love to kind of hear, are you really concerned, somewhat concerned, not that concerned? So feel free to chime in. And actually, while that's queuing up, while you guys are responding there, I just want to take a moment to note that no tax law changes have been passed thus far. Much of this discussion is still campaign trail highlights, which are just that, highlights. It's not fully packaged and ready to go, which of course makes planning that much more difficult. Additionally, we still need to wait and see what happens with the Georgia runoff election and how that plays out in January. If the Democrats grab those last couple of Senate seats, then we could see some changes happening more rapidly. So let's see how we're doing here on the poll and see if we have some results coming up here shortly. I am really curious because, we hear a lot from individuals and a lot of different reactions. So here we are. We have about 10% very concerned, 41% somewhat concerned, 13% neutral, 18 little, and 3 none at all. So I would say, tilted definitely in that concerned category. So let's crack this open a bit further. And I'm gonna pull up my slide here. I'm gonna go into kind of some of the details, but just at a high level, President-elect Joe Biden has been very vocal about his desire to increase taxes for families earning more than $400,000 per year and not increase taxes for families earning less. There are, some pieces that may trickle down to families earning less, but for the most part, the changes really are targeted at that kind of top percentile. And the projected result of those changes would bring in an estimated $2 to $3 trillion of additional government revenue over the next 10 years. So let's cover kind of an overview of some of the proposed changes that most directly impact individuals. There are some other items focused on corporations, corporate taxes and the like, which I'm not going to get into the details today. But on the individual side, starting at the estate and kind of working our way backward, the first item that we have here is related to inherited assets. So the possible removal of the step up in basis on appreciated assets at death. For example, let's say Joe had a long career at Air Products and has purchased $2 million of stock over the years. That's what he paid for it. That is his cost basis. If that grows to $3 million at his death and is passed along to his daughter, Susie, she would receive $3 million of stock and her new cost basis would be $3 million under current law. If that's taken away completely, then Susie would need to pay capital gains tax on that $1 million of growth. There's some discussion about adding in a $100,000 capital gains exclusion per person, and then keeping that primary residence exclusion up to $500,000 for married couples, perhaps adding in some relief for small family businesses. But it all needs to be kind of worked out. I will say, out of everything on this list here, in my opinion, this will probably be one of the most difficult parts of the plan to enact. I would expect a lot of pushback in this area. So then the next item, this gift and estate tax exemption, reducing that down. Right now, our estate tax exemption for any individual is a little over $11.5 million per person. So that's what you could, in theory, pass along federal estate tax free for the most part. So the discussion is to bring that down to the $3.5 to $5 million range per person, of course, tied to inflation, and then also increase the estate tax rate from 40% to 45%. Now, this might sound like a really big change, and really it is. However, we're only stepping back a couple of years here in pulling that exemption back because the ramp up to 11.5 million happened so rapidly. So I would not be surprised if something happens in this area. I just don't know exactly where those numbers would land. but I think that it might get through a little more easily than some other items on the agenda. And then the next one is the top income tax rate. So increasing that top rate from 37% to 39.6%. This is actually a little bit deceiving because it looks like it's only a 2.6% increase, but this new bracket actually kicks in at income of $400,000, as Joe Biden had mentioned. That's kind of what he's targeting. Right now, though, $400,000 of income falls into the 32% tax bracket. And then the switch over to 35 happens around $415,000. But if you're looking at going from 32% taxes up to 39.6, suddenly that's a 7.5 or 7.6% increase, and that's percentage point increase. It's actually a 22% increase in tax for that money that's sitting right there at that cusp. All right, let's hop back here. The next item is Social Security tax. And the proposal is for wages above $400,000 to apply a Social Security tax of 12.4%, rather than the current wage cap at $137,700, because that's the maximum amount that the Social Security Administration uses to calculate out benefits at that $137,000. So up to $137,700 right now, if you earn that as an employee, a W-2 earner, you pay 6.2%. Essentially, this new tax kicking in at above $400,000 at the 12.4 rate is kind of like taxing it as a business owner. That's paying both the employee portion and the employer portion. And then deductions. So a new cap on itemized deductions, capping them at 28%. So if you're in that top bracket of 39.6% and you have $100,000 of deductions, keeping the numbers very simple, you'd save about $39,000 of taxes. This would reduce that down to $28,000. So you would the benefit that you get would be at a lower bracket. Now, while there's discussion about reducing the deductions there's also some talk about repealing the cap on state and local taxes and real estate taxes, which are currently capped at $10,000. So there's kind of a plus side to there that we'll talk a little bit about as well. The next item is long-term capital gains. For households with income above $1 million, the proposal is to tax them at the rate of 39.6%, so at that top ordinary income tax rate, rather than the current advantage 20% rate right now. At $1 million during one's lifetime, this will impact a very small percentage of the population. And once again, in my opinion, is actually a much milder change than I would have expected to kind of hit that $1 million threshold first. But that being said, the kicker is that if this is coupled with the removal of a step up in cost basis upon death, suddenly you could have significant gains at the time of death, throwing your income over that $1 million and then subjecting those gains to ordinary income taxes. That's where I see this playing out to a larger population. Many of these items are still being negotiated and need to be determined. Nothing is set to go into effect, as I mentioned. However, I do think that it's fair to recognize that right now we are living in one of the most tax advantaged environments of our lifetime. So some type of change is inevitable. That being said, it's also fair to assume that the more they try to pack into that tax bill, the further that bill will be pushed out. So large sweeping changes may not happen until 2022, 2023. I'm not sure exactly when, but there are a lot of big items on the agenda to address first before they get to some of these tax law changes. So from here, what I'd like to do is take a look at some of these changes in practice. So the Wall Street Journal profiled 5 different American households to see how these changes could take effect. And here we have a family of 4 with household income of $800,000. We can see, some of their different deductions there, bringing them from an effective tax rate right now of just under 32%. And this would bump them to the changes would bump them to a new rate of just under 36%. Remember, even if you're in that 39.6% top tax rate, your effective rate is lower because not all of your income is taxed at that top rate. And you have things like, deductions offsetting that income as well. So with this family in mind, I would actually like to share my screen, and I'd like to share a tool with you. This is our financial planning tool. It's through eMoney Advisors. It's going to take me just a minute to get to it. Here we have the Miller family, and we have a wage income of $800,000 and an effective rate of 32%. Now, there are a lot of other assumptions that go into this, like their personal expenses and rates of return and inflation. But this is giving us a look at their projected portfolio values over their lifetime. So we can see, this ramp up in these first few years here as they approach retirement and they're building up their portfolio assets. And then when they get to retirement, it starts to flatten out a little bit as they start to draw upon that portfolio. Now, what I'd like to illustrate is not changing anything else in the assumptions, but just moving them from that effective rate of 32% to an effective rate of 36% and top to that. And we can see how that impacts them, kind of overlays it and compares between the two of them. So, and we can see here in the beginning, it's a smaller amount, but that smaller amount on a year-over-year basis compounds. And so by the time they get to retirement, their pool of assets from which they start drawing upon is a smaller pool. When they start taking out the money, we can see as they get into the later years of retirement, as things like inflation kind of creep in and increase their expenses, and they're drawing more and more from the portfolio, a little bit more of an acceleration down here at the end. But this is, as I mentioned, this is the decision center. And I don't expect that we're going to have these same tax laws for the next 40 years. That's, slim to none chance that that's going to happen. But it's important to begin to understand the potential impacts because it makes every other decision that much more important. So things like Social Security. The Miller family right now is planning on starting Social Security at retirement at 65. What if they delay that until age 70? And we can see the changing impact. So that was, kind of a positive impact. That was a positive impact for them. And it also helps to determine the levers that they have to pull. And so if they wanted to do, different things, if they wanted to build out special vacations, spend extra money during different points, are they still comfortable with this? Maybe to offset that, they sell their vacation home. So this just kind of allows us to mix and match a little bit to see the impact of the different decisions, both positive and negative, but also start to model things out like these different tax implications or these different proposed tax law changes. So I am going to hop back over. At least I think I'm going to hop back over here. All right, here we go. And so, kind of in conclusion, I just wanted to illustrate, some of those different changes. And I thought you may be asking, or even in advance of this, you may have started to ask some questions. And so I thought I'd kind of bring up a couple different questions to talk through how they may be impacted by some of these proposed changes. So number one, should I accelerate income into 2020 or defer to 2021? Quick caveat, obviously everybody's situation is unique and I can't address everything that you have going on in your individual lives, but this may spark a conversation, going forward. It may be wise to kind of take this a little bit deeper. So if you expect your income to be greater than $400,000 next year, and you have the ability to pull some of that into this year, then it may make sense. But you just need to recognize that you would essentially be prepaying taxes and would lose other uses for that money. So, and I also think that if you're kind of on that cusp, it may not be worth the gamble. But if you have a large transaction already in the works, pushing you well over the line, then I'd probably try to wrap it up by year end, or at least, dig into that a little further to see what that would look like. The next item, should I try to sneak in a Roth conversion before year end? Once again, I'd love to look and see where you're projecting to land income-wise. I think a Roth could make sense this year if you were already planning that strategy into your larger plan, or if your employment income is lower this year due to COVID impacts on your business or your job, and maybe you're already landing in a lower income bracket, then it makes sense to take advantage of that as well. Going back to that discussion or that mention that I said about the state and local taxes, perhaps in removing that $10,000 threshold. So the question is, should I pay my state and local taxes before year end? Assuming you've already hit that $10,000 threshold, because that's a fairly low number, if you've already hit that with your state and local taxes and your real estate taxes, then I would defer your final payments into next January, because there's no additional tax benefit for you to pay them this year. But yeah, there may be a slim benefit pushing them into next year if that deduction restriction is lifted. And then finally, I want to make a large charitable contribution. Is it best to do it in December or January? If your charitable contribution will not push you above the current standard deduction, i.e. you wouldn't need to itemize, I'd recommend cutting that check on January 1st, or better yet, transferring appreciated stock, or doing a qualified charitable contribution from your IRA if you're over age 70 and a half. If you're over age 72, then that would also help to satisfy your required minimum distribution for next year. However, if your charitable contribution is large enough to warrant itemizing your deductions and you're in a tax bracket above 28%, then you may want to make the contribution this year to potentially capture a higher deduction amount. So I hope that is helpful. And let's see, there's a question here. Is the Social Security trust at a greater risk under the Biden administration? I don't know that it's a greater risk necessarily. I mean, we'll have to see how some of these play out. The fact that he's building in some pieces to try to boost those contributions into that trust, I think is very helpful. And we still have to remember too that the trust only provides, I think it's about 26% of the benefit payouts. Most of the money paying into the Social Security system is from current workers. So I don't see a negative impact just yet, or I don't know that it's at necessarily any greater risk at this point.
Katie, I think might share. We found a great, listen to a great podcast with a guy named Steve Vernon from the Stanford Longevity Center, who had some interesting perspective on just how at risk Social Security is structurally, regardless of political party, and just what levers can be pulled. Maybe we can share that out in the afterward notes, because it really does a deep dive into the long-term solvency of the system and how it would work if the trust is depleted, and how it's really dependent upon payrolls and what that would mean for benefit cuts and everything else. So maybe we can share the Steve Vernon podcast out.
Yeah, that's a great idea. Love that.
Good question.
All right. And with that, actually, I'm going to hand it back over to you, Dennis, if you want to talk about what does 2021 look like, kind of going forward a bit.
Excellent. So we spent a couple minutes looking backwards. And I've received the question a lot in the last few months of what is the benefit of history when we're living through such an extraordinary time. I mean, there's no precedent for all of the things that are compounding in the course of this year. But there was a interview with Ray Dalio, who's the chairman of Bridgewater Associates, the largest hedge fund in the world, recently, when he said, this is a 100-year event for sure, that this is a unique event. But there are some events that don't recur in the course of our lifetime. We're supposed to get a 5 or 10% correction in the markets every 12 to 18 months. We're supposed to see recessions every few years. There are political cycles and everything else that might last a decade or more. But some events don't show up for 100 years at a time or 200 years at a time. So I think it's helpful just to look back for a little bit, but then look forward to say, there are some unusual things that can happen in any given year. How can we make sure that we control what we can control? And this is where we really want you to focus today. Planning for 2021, we believe there are 4 things that are in your control: diversification, risk, cost, and behavior. So we're going to talk that through a little bit, and then talk about how that can benefit you from an investing perspective. So I love this line, especially in a zero interest rate environment where you have to decide about the cost of being safe. In investing money, the amount of interest you want should depend on whether you want to eat well or sleep well. Well, the sleeping well factor, I think, is really important for a lot of people right now. So our first chart, Cody, you want to talk through what this is? First of all, we are not prognosticators. We're not making predictions, and this is why.
Yeah. So this is some of the predictions from some of the top hedge funds or some of the top analysts that at one point said that the market was pretty much going to go down to zero. They just had really pessimistic views. And this is showing, if you listen to them and you took out $1, say at the top here, and put it into, if you took $1 out of your stock market weighting and put it into bonds, this is how much underperformance you had if you listened to them on that exact comment, if you took it out on that exact date.
Yeah, this chart in particular, what it tells you is that these people decided there was some outcome that could occur. And what we tell people is there's no difference between being wrong and being early. They're indistinguishable. So even if you got it exactly right, but it took a decade to play out, missing out on 3, 5, 10 years of returns can drive you down. These people are they're economists, they're fund managers, hedge fund managers, columnists. I mean, they're people who have good reputations. But a lot of what they do, in contrast to what we do, is we can have a career making trade. So one thing happening, one catalyst going right, and they can, be the one who predicted this or predicted the thing. And we don't want you to be in the business of career making calls, nor do we want to be in the business of career making calls. So it just goes to show that these are very smart people, but we don't want to make predictions.
Yep.
All right. So let's talk about what the data tells us about return expectations for the future.
So this chart, as we talked about earlier, so the PE ratio, so this is how much you are paying per dollar earned for the company. So obviously this depends on each individual company. Like Tesla's is crazy high right now compared to, say, a financial firm like Jpmorgan. Theirs is a little lower, obviously, because they think the growth of Tesla is going to be a lot larger from Jpmorgan. So that's why they're willing to pay a much higher PE ratio. What this is showing is the PE ratio for the US market as a whole. So right here, we're pretty high valued. But with that said, this is the 1-year return. So obviously we have some very positive years, and then some years we obviously have some underperformance. And this is just what we thought it was important to point out, that with the higher prices, we may have to have some lower expectations going forward for the next couple of years. But it's also important to point out that this is the US stock market valuation. International is still pretty undervalued compared to the US market.
Mm-hmm. Yeah, definitely. The more expensive things get, the higher price you're paying for that dollar of earnings, the wider range. And you can still have, I mean, we hear people saying the market's really expensive right now, I expect it to go down. But you see, there are certain years, these plots up here are years when the market jumped by 20%, even when it was highly valued. So you're it's that walking a tightrope that happens in the short term. But Cody's exactly right. In the long term, at these valuations where we are now, there's a cluster of returns closer to zero. And that's what we have to be very clear-eyed about, is how much risk are we taking to get to that number.
Yep. And then the next chart, obviously this year is not a normal year emotionally or just overall, but in the stock market, actually kind of is a normal year. So what this chart goes over is the gray are the yearly returns. So we are positive over 75% of the time, but every single year you can see we have a large decline at one point. So these red dots are their inner year lows that we've had over the past 40 years. So we have an over the average year, we have an inner year drop of around 14%, so 13.8%. Every year we have a drop of around 14%.
Yeah, you can see this is kind of a year like 1987. Look at that, negative 34% to finish the year positive. That was the crash of 87. Here we have the same thing, a negative 34 drop. And as I said, we're still going above 15 as of today's writing. So another thing this highlights is the randomness of picking the end of the year to make decisions on performance, because at different points in the year, you take a snapshot on a given day and it can tell a completely different story. So emotionally, it can be hard to do, but you get to a normal year through a lot of this wide range of outcomes. And I would expect next year, there are certain things that are going to be variable. Like we could have a dramatic increase in economic activity as we return to a post-pandemic economy and some of the normal activities that we would do. But there are certain things that are going to remain static from the way they are right now. So Federal Reserve policy, interest rates are going to remain very low. The Fed is going to remain very accommodative. So that's not going to change. And that's really what's driving a lot of this market movement this year. So there's a little bit of a disconnect between what's happening in the real economy and then the fuel that's pushing things forward. So always look at what things change and what things remain the same. The Fed is going to be stable and accommodating the economy well into the next several years.
Yeah. And then the next slide goes over some of the returns that you can expect over the long view. And this is why even at the high valuations, we still want to have a weighting in stocks, bonds, and make sure that you're diversified, because over the short term, obviously you can see the vast difference of opportunities you have in the stock market. So, I mean, sometimes positive 47% in a year. Obviously, other times we've had some bad years of down 40%. But if you look just at the 5-year rolling average of stocks, bonds, and a diversified portfolio, you can see the worst return you've had if you were invested in stocks over a 5-year rolling average was negative 3%. So this is why even at the high valuations that we have currently, we still want to be diversified in stocks and make sure we're diversified in bonds too.
Right. I think the interesting thing on this chart is looking at the expectations for stocks are one thing, but expectations for bonds are another. Now, bond prices go up as interest rates go down. If we look at the last 40 years, so this is from 1950 through 2019, but the last 40 years of that window, you look at your bond returns and they're pretty close to stock-like returns. Look at that, 16% over 10-year rolling period, 16% per year versus 19% for stocks. The reason for that is I'm sure there are people who remember having a double-digit mortgage, or having where interest rates were in 1980. And we're going to show you a chart in a few minutes just to say there are investors have benefited from that. If you own stocks and bonds, you've benefited from rising asset prices and declining interest rates for a significant amount of time. But what does that mean right now, right here and now at the end of 2020 for our return expectations for the future? And I think it's a little bit different. So, we've really benefited from a substantial bull market in stocks and bonds.
Yep. So this chart, exactly what Dennis was talking about. So this purple line goes over the decline that we've had in the 10-year Treasury rate. It's down 87%. So this started obviously around 8%. Now we're down to what? Depending on the week, 0.8, 0.9 for a 10-year Treasury. With that, like Dennis said, when the rate's dropping, the price of the bonds rise. So you've actually gained a lot on the bond appreciation. So that's why we've had that great return in the bond portfolio.
A wise person said to me recently, looking at this chart, you will never see this again. It's just an extraordinary thing. If you bought the Vanguard Bond Index, you benefited from that rise. But if you're investing now, you have to realize that there's a 90% discount. The average was 4% over time, 90% discount to the amount of interest that you can earn. And you have to manage your expectations accordingly. You're not going to get 2, 3, 4% from your fixed income, and you're exposed to the opposite. As interest rates rise, bond prices fall. So there are strategies to make sure you mitigate that, but that's why back testing is really hard. All right, so I'm going to zip through the next couple of slides here because I want to leave time for questions as well. So this is something that we came up with recently. So when we create a financial plan, when Katie showed you that demonstration in eMoney Advisor, and we have to assume certain things, a certain amount of or a rate of return, an inflation rate, a certain amount of spending, a certain amount of growth. We'll come up with an average. Maybe it's 4%, 5%, 6%. But we had this thought recently, how do you get 6%? And there were some interesting data points. So if we talked about growth stocks and how for the last 10 years, that's the place to be. They've averaged 16.3% over the last decade versus US stocks at 13 and real estate at 6. But if we look at the 20-year average returns, if we look back to 2000, the return is only 6.5% per year. So how did it become only a 6% rate of return when you've averaged significant double digits in the last decade? Here's how. This is a chart of a few different markets over the course of the 2000s, the decade of 2000 to 2010. And you have, right here, you have emerging markets in blue that returned 267%. In the purple, you have US growth stocks. So this was, Amazon and Apple back in the day, or the Googles of the world. The tech bubble burst, they sank like a stone, and they spent 10 years underwater with a negative 14% return over that time. So with that negative 14%, it's only been through the last 10 years. Now remember, blue up here doing really well, purple down here doing really poorly. The last 10 years, here's your tech stocks, your growth stocks, earning 395% over the last decade and 44% for emerging markets. They inversed, they flipped. This is what happens all the time. Going back to that Callan chart, this is how it really gets to time in the market, that you get to 6% by not being concentrated in any one thing, because any one of these assets can spend a significant amount of time out in the wilderness. All right, so we're going to wrap this section by saying, where do we focus? Here's a couple of thoughts on what to do in 2021. First, diversification, not concentration. Don't be so consumed with what's worked this year or for the last couple of years, because there are rotations that happen. Look into international stocks, small cap stocks, and assets outside of just US index funds. We've spent a lot of time this year not just concentrating on the balance between stocks and bonds, but what type of stocks, what type of bonds. That kind of decision matters. Next is risk. Be careful not to fixate on market risk. Liquidity risk is another one. Make sure you can access your money, that you can move, that you can flex, make changes when needed. If interest rates are low, even low inflation can eat into your returns for bonds, for cash. So make sure that you're not being too risk averse, because we're not earning much, and a little bit of inflation could be detrimental. Cost, Katie made a great point on this. Cost in investing, trades are all but free right now. Hopefully they're all but free for you. And then cost of mutual funds and index funds are coming down, but taxes are going to matter. Every incremental decision, look at the cost of your decisions for where to draw from for your income stream, how to be tax efficient through municipal bonds versus taxable bonds, all of those things. And lastly, behavior. And this is the hardest thing to do. There's a temptation to try and be heroic and to say, in 2021, if you do this, you will win. We know that's not the case. The more heroic thing to do, and the more principled thing to do, is to have a rebalance strategy. Make sure you're checking in on your biases. Make sure you're filtering out the unnecessary noise. This is why the planning always comes first for us, because if we can acknowledge kind of those instincts to try and get in or get out or chase after performance, if we can manage those, then we can really keep us from making the big mistakes that happen, at market highs and at market lows, which we've seen both of this year. So I'm going to pause there and see.
There are a couple questions.
Okay, let's see what we have here. Great. So international developed markets exposure. Think about U.S. large cap or developed markets funds or some combination. So when we invest internationally, and I'm just to make sure I understand the question properly. Do we think about developed market funds, some combination U.S. large cap? It's always a combination of U.S. and international. They move at different times for different reasons. There is some overlap. So a company like Nestle and a company like Coca-Cola are both global brands that are approaching marketplaces internationally and in different countries. But they occupy in different countries, they're domiciled differently, they pay different taxes. So, and they're also going to be tilting in different ways for different directions. We prefer a balance between domestic and international. We sometimes even recommend funds that have the ability to tilt inside one way or the other. So some managers, if you buy an S&P 500 index fund, it has to stay in that space. If you buy a developed international index, it has to stay in that space. Sometimes you can use a global fund that has the ability to tilt one way or another based on where the fundamentals are in the economy. So I hope that answers one of the questions. The second question is the guidance for the percentage of your portfolio to be invested in equities based on 100 less than your age still appropriate? If not, what's the latest theory? That's a great question. That's a Jack Bogle question. So Jack Bogle was the founder of Vanguard Group, and his philosophy was you take your age and subtract it from 100, and that's how much you should have in stocks. So if you're 70 years old, you should have 30% of your portfolio in stock. I think that really works when you back test it. As I said, look over the last 40 years. If you had 70% of your portfolio in bonds over the last 40 years, or you were increasing your allocation to bonds, you look pretty smart because bonds were going up and rates were going down. If you were to take 70% of your portfolio and put it into, a 10-year treasury bond right now, I would venture to say that you're taking on some pretty substantial risk unless you think of what types of bonds that you own. So I don't know that there's a current strategy that's dominant, but I do know that there's a lot more thought being put into, take a stock like Apple. Of course, Apple's going to go up and down, but it pays a dividend and it's sitting on a huge pile of cash, and that dividend is increasing every year. Is that a way to keep increasing your income stream? And a stock paying 2%, which is roughly what the S&P 500 pays, is a heck of a lot better than the less than 1% you're getting on a 10-year treasury if you can handle the volatility. So it's not as simple as that rule of thumb on age anymore, just because of where interest rates are.
Hey, Dennis, can I throw another kink into that as well?
Yep.
I think there's a planning consideration too. So depending on what your income streams look like or are projected to look like in retirement, if you have a large pension, for instance, you may want to treat that like fixed income, and then in your investment account, you can probably be a little more aggressive. So depending on what your income stream looks like throughout retirement and your level of resources and everything else. So I wish there was a simple rule of thumb there, but it really is kind of unique for everybody's situation.
Yeah, that's a very good point. Yeah, that was actually one of my questions, Katie, is how do you think about creating a paycheck? And I think that's something that we've talked about for years. The most difficult thing to be is a conservative investor. And how do you create that paycheck? We definitely advocate a total return strategy. You're taking a little bit from stocks, a little bit from bonds. You're actively harvesting gains and being tax efficient. So, when you're in a long bull market for stocks and bonds, that masks a lot of inefficiencies. We're recommending that people really focus in and be really efficient in their investing.
Yeah.
So, any other questions while we have everyone here? I think we're coming right up on an hour's time. Give me another second to see that. All right. Very good. Well, again, to summarize, we hope everyone's gained a little bit of insight on what happened this year, hopefully gathered some pointers and some perspective on what could happen from a policy perspective and from an investment perspective. Feel free to reach out to us if you have any follow-up questions. And let us know if we can ever be of assistance to you or your family. We wish you all the best this holiday season. And thank you for being part of our community today and every day. Thanks so much.
Thank you so much. Take care.